talking about building versus preserving wealth, right? Those are two very different approaches. And I think that if you want to build wealth, you must concentrate. And to preserve wealth, you diversify.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to today's show on Wealth Strategy Secrets. Today we're joined by Maxwell Wu. Maxwell is the founder and mind behind Fulcrum Lending, a top lender for multifamily properties nationwide. His career began at C3 Capital Partners, and he later earned a master's in real estate from Columbia University. He's got extensive experience in real estate investment and operations, and Maxwell has overseen over $10 billion in real estate acquisitions and even managed institutional private equity funds worth over $1.5 billion. Maxwell has developed cutting-edge PropTech platforms and products for various sectors in the real estate industry. And prior to founding Fulcrum Lending, he held significant positions at reputable firms in New York City, including fund manager, investment banker, and principal investor. And we thought it would be great to have Maxwell on the show today to really talk about the latest in the lending environment, what he's seeing, some of the innovation that's taking place in the space. So welcome to the show, Maxwell.
Thanks for having me, Dave. Glad to be on.
Yeah, you bet. I think this is going to be a great conversation. And I know this is really top of mind right now, right? As we're in the beginning of 2024, we saw significant rate hikes. I mean, frankly, unprecedented rate hikes by the Fed last year. Lots of talk already about, making, significant drops this year. I know you don't have a crystal ball, but you're definitely closer to the lending industry. And I'm also curious about, really the innovation, right? Because when we're looking at deals and we're betting deals, right, I think it's important for investors to understand, how important lending is on the capital stack, right? And how should they evaluate deals based on that, right? Because sometimes those terms aren't necessarily as advantageous. And we've certainly, we're running into some significant headwinds for people in the industry, that did their underwriting a couple of years ago and everything. So before we unpack that, why don't you tell the audience a little bit about, your background from, getting into real estate, investment banking, and what kind of led you here?
Yeah, absolutely. Definitely a lot to unpack between interest rates and the current environment. But yeah, to start off with myself, I started off in real estate in distressed private equity, focused on buying, distressed assets, distressed from control, really going through either, note purchases or REO. From there, went into investment banking, venture capital, ultimately found really a true love within real estate and real estate operating companies. From early on, right, I was fortunate enough to see the various forms of structural leverage, aside from just really capital being used as leverage. And what I mean by that is really seeing the power of what, investment management firms, lending businesses can create as they're the primary conduit for capital entering the market. So if you're at the gates there, right, there's a lot of interesting things you can do as a business, and a lot of, as I mentioned, leverage, operational leverage, structural leverage that comes with that. That's really where I became intrigued with operating companies within real estate. And, my background within just investing in real estate, also understanding the debt component, investing in credit instruments. It really gave me a unique perspective in, building a business around a very solid, I would say in a solid environment. And that what that environment is strong real estate fundamentals, right? I think, the key to building really any business is it's got to be a very friendly growth, fostering environment to be successful there. But if you're gonna send something to the moon, you got to make sure that launch pad's solid, right? Just to use that type of analogy. But been fortunate enough with the economic climate, the backdrop there, being able to provide a lot of opportunities within lending. But it's a story that when you look backwards, it makes a lot more sense than when you are going forward. But yeah, I mean, we're excited about the opportunity ahead, and what we've built thus far with my co-founder and CTO.
Yeah, no, that's very cool. So, why don't we just kind of pull up to kind of a 30,000 foot view, right? And, let's just kind of talk about debt at that macro level, because this is kind of interesting, right? And, we're always trying to help our investors become smarter, more sophisticated. And we've had syndicators, PE firms in here that have said, they don't take on any debt, right? Like literally, zero LTV, and they think that's, the secret solution. To other people, who've levered up quite a bit, 85, 90%, some of those maybe too aggressively, right? Is there kind of a sweet spot in terms of the actual, the right LTV or the right mix of debt, or when is it really appropriate for an opportunity?
You got to be really smart about the leverage you take on. Ultimately, it's an obligation that's senior to the cash flow you're receiving from the property, and you've got to pay those folks back, the lender back on those dollars used. As you mentioned, it takes up a lion's share of the capital stack, so you really got to make sure you're choosing them right. You're choosing, something that someone and a product, right, that can work with you up and down. But oftentimes, aside from just kind of finding, let's call it the right lender, it's oftentimes just being very prudent and eyes wide open and managing your own leverage. And, taking the approach where you say, looking forward, you have upside, base case, downside scenarios, and you got to be able to put some type of probability on that, right? You got to have the understanding that things don't always go right. And if it does go wrong, what do you do? So if you're prepared for when things go bad, right, it's not so bad when it happens. And part of that foresight is just not taking on tremendous amounts of leverage. Now, that being said, right, there are certain investment strategies, right, for real estate where it makes sense for bridge debt. But I think that if you canvass the market and you find the right lender and the right products, you'll be able to take on, higher leverage loans that don't have as short of a fuse, because it's the time that kind of kills some of these investors or these investments, because these bullet maturities, let's call it 2-year bridge loans, high leverage, 80%, you've got 24 months to execute your business plan. Sometimes, there are headwinds. Sometimes there's some drag in the predictions or the assumptions you have in your business plan. So, again, sensitizing for that, saying, if this does happen, will I be in an okay place? And, again, it all comes back to managing that initial leverage you put on.
Yeah, no, that's really a great point, is that time horizon, right? And, when you look at some of the best family offices and how they invest, right, they're always looking at least a 5-year cycle with an investment so that you can manage through any given, cycle, right? So you don't have to be a seller in today's market, right, while we're having, some pressure, right, on cap rates, but, you have that longer run rate, and then you can sell, in two years when rates start to come back down. That's great flexibility.
Right. I mean, and you bring up a great point in terms of cycles, right? That's kind of one of the first things you learn in real estate, or one should understand in real estate, is that it is a very cyclical business, and understanding where you are in the cycle is sometimes just as important as finding the right investment. Again, going back to building a business in a hospitable environment, right? Similarly, you want to make investments in a very supporting environment for that. So having an eye to where we are from where we were, right, is really important.
Yeah. So why don't we go into that? Where do you think we are in terms of the real estate cycle in the debt markets as we enter 2024?
I mean, we're certainly not in the early innings, and we're certainly not in the middle. We are squarely at, I think, towards the end of the cycle. It's just a matter of when the music stops, right? And, that's a fairly draconian kind of way of putting it. And to be clear, I don't think it's going to be as draconian as I maybe make it sound. But I think, as you're in the later part of the cycle, you got to understand what happens on the value reset, right? Going in eyes wide open, taking a scenario approach, upside, base case, downside. If things were to reset, where are you, right? And the thing is, there's been, a bull run for 11 plus years. And we look at cycles are typically, 7-10 year cycles. We're at we're at the edge of what a typical cycle would be. So that's just kind of some more heuristic assumptions, but also taking a look at historical data and the cycles there that allow me to make that assumption. But how you navigate and how you invest and how you put money out in these cycles, right? It's definitely a shift from equity exposure to debt or credit, taking a more fixed income approach, because as you're at the later parts of the cycle, right, you're going to be kind of on this downward slope, and then there's going to be a slow recovery portion, and then it's going to go back up. On this portion, right, what are you supposed to do, right? When you're heading down on the cycle, down to the trough point, you can't really just sit on money. You want to be able to, put money out, make a return. Credit is a great place for that. There's current cash on the deal. Right now, you can get equity-like returns for debt-like risk. And that's a very unique place to be in the economy, right? We haven't seen rates this high since, the 80s don't even, 70s don't even match it, right? I mean, it clearly surpassed where we are today, but that's a good reminder of, where we are relatively, right? And what we do as investors, it's all relative value, right? And you have to be able to understand relativity. So zooming out, zooming in, understanding where you are allows you to understand that context and position yourself appropriately. Again, I'm not saying I can call the top, I can call the bottom, but what I can say is that when you can identify shapes appropriately and make directional choices and know that those directional calls have some legs to it or some duration on it, right? You can build a solid investment strategy to withstand those periods of uncertainty.
Yeah, no, I think that's really a great point, Maxwell, right? Because, as investors, by recognizing that cycle, you also have to map that to, your own investor DNA, your own risk tolerance, and also, where you are on your own personal cycle, right? You might be 62, or you might be 38, and you have definitely a different viewpoint on those cycles, how you're going to allocate capital, what's most important for you, to structure that.
Absolutely.
So how about, from a lending environment right now, have the requirements become, are they a lot stricter today? Are the standards going to be, kind of loosening if they start reducing rates?
Yeah, when we think about tightening and loosening of credit standards, right, that's really a mechanism to win more business, right, volume, right, for banks in particular, right? You've probably heard this term cov light or covenant light in terms of loan documents, the covenants there that require borrowers to maintain the property in a certain way, to have certain structural aspects that manage cash or certain qualifications, for the borrower, right, as a sponsor. And you'll see these tighten and loosen in up and down markets. Typically in the up markets, right, there's going to be loosening because there's just competition for loans. Right now, to answer your question, right, covenant or really lending standards are tightening a lot. Cash out, definitely a lot harder to get. A lot of lenders, a lot of credit investors want to see that there's still skin in the game, that sponsors have not cashed out and that they're playing with house money, right? They want investors that are going to be with them side by side. And it really comes down to, quite simply, just alignment of interest, knowing that their dollars are going to be the first thing to be gone in the downside scenario, and then the lender position, first mortgage, first lien, is going to be protected. That's the whole point of lending and credit investing. It's always principal preservation and then making sure you're getting a fair risk-adjusted return. That's really it in that order. And that also goes, I would say, towards, as an investor, sometimes some people are a little bit more risk on, some people are risk off, right? Banks in particular, they protect your money, they hold your cash, they hold your life savings, your kids' college funds, right? And they can't lose that, right? So they're doing the right thing and tightening the standards and making sure that they're protecting your cash.
What do you think about asset classes specifically within commercial real estate? Is there anything that you're bullish on right now? Industrial, multifamily, build to rent, any areas in particular you like?
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
I mean, look, I'm biased, right? We only lend on multifamily, and that's for a variety of reasons. But in terms of, what we're focused on, right, we like the multifamily asset class because the deep amount of liquidity in the market. And what do we mean by that? It's that there's a large amount of government support through the likes of your Freddie Mac, Fannie Mae, multifamily, in addition to federal, the FHLB, the Federal Housing or Federal Home Loan Bank. And that provides liquidity to banks for the mortgages that they hold on their balance sheets. All that's to say is that there's a lot of recognized value in the asset class that provides, liquidity in the case that you need it, in case that you need to sell the loan, in the case that, you have to take any impairments. You're seeing it right now with how things are unfolding with the banks. And, the multifamily book, as a part of the larger CRE book, is certainly held up its marks. And all the other assets, office, retail, hospitality, they're trading at huge discounts. And that's just a reflection of the economic environment. So, that's one element why we like multifamily, not only from a credit perspective, but an equity perspective, that there's always going to be liquidity in that space. Second is that if you're taking a look at, let's call it the hierarchy of spending for an individual, and you look at a consumer's wallet, multifamily, let's call it just housing, shelter in general, right? That's just, forget multifamily housing. Housing and shelter, at least 30% of their wallet. I don't know any other portion of spending that takes up that much. The other side is that to change your living situation, there's an incredible amount of friction related to it. You've got to, get movers, pack up the house, move in, find a new place, find a new school for your kids, maybe, find a new job, right? There's a lot of disruption that comes from that versus changing your brand of cereal, going on less vacations, maybe eating out less, right? And all that goes to impacting industrial performance, retail performance, hospitality, office, right? All these things are so interconnected. So if we're being really taking a very scrutinous look at, where we want to invest, right? This seems like a very, very, safe area to be. Again, speaking for ourselves and not providing advice for others, it's something that we have understood very well, and through our time and through a lot of data, have come up with a compelling thesis for multifamily credit investing. That's what we do. We do that all day. Like I said, we don't do any other asset class. Now, there are other more opportunistic spots in CRE, right? Office, I think, is kind of the thing that everyone's been reading in the headlines. And look, do I think there's been a severe sell-off? Absolutely. And do I think that there are going to be some diamonds in the rough there, absolutely. But that's just what happens when there's a big scare like that. You have this contagion effect, and that's where you really find some nuggets. But that's a very niche play, a niche investment avenue to be going. And what we like is we like scale, we like stability, and we just think that we can do it a little better than the next person. And that's what gives us our advantage. A lot of data and technology that we use, and the financial products we're able to create. It's a different way of. Well, I'll back up and say, depending on what you want to do, which is find niche opportunistic deals or find a lot of down the fairway, very safe deals, right? You got to ask yourself what your personality type is. And, for myself, right, it's always been, again, going back to principal preservation first and a fair risk adjusted return for my money being out. And, it's a personal preference. So given my personal preference of the latter, right, safe investments, steady investments, that's kind of also why I think multifamily makes sense.
Yeah, we would concur with that conclusion, Maxwell. And I think what you did is really highlight, the macro fundamentals that are so important, right, to look at as an investor. The fact that, from a supply demand perspective, some markets, especially Southeast, Southwest, continue to have a huge influx, and they just don't have enough product, right, in place in many of these markets. So if you can position yourself that way, and then, like you said, right, it's housing is a basic need on Maslow's hierarchy, right, and people need a place to live, and we can all relate to that, friction component of actually having to move, even if times get tough. It's probably the last thing, that you might cut down on. And that's, that goes A, B, C class, all of those different classes as well. So, to me, I see a lot of that as like risk mitigation, right? The more stable the asset is, the more things you have in your favor that are going to mitigate the risk. You can manage through cycles, you can manage through, different things that are going to come your way, right?
Absolutely.
Yeah. So what do you think about institutional money, right? Because it's been kind of interesting, right? Because I think multifamily, especially the past, I would say 5 to 10 years, I've been investing in multifamily for almost 20 years now. But the past 5, 10, there's been a big, I would say surgence in, deal flow, operators, people getting interested in the asset class. And it's also interesting to look at, how is institutional capital moving, right? Between, REITs, pension funds, are they getting, is more of that capital being shifted into the multifamily market? And are you seeing a trend that's on the rise?
I guess institutional interest in multifamily, it's definitely always been there, but I think as of recent, it's really starting to show that this is where they should have allocated more dollars. I think the smaller balance multifamily, smaller units, I should say, let's call it sub 100 units, that's really the less institutional, I would say, part of multifamily in general. So that, everything from 5 units all the way to 100, right? Institutions really aren't touching that. And that's for a variety of reasons, including scale and just operational, difficulty there. But for us, right, we help de-risk these smaller deals for institutions, right? We, again, going back to the amount of data, the amount of diligence we're able to put through, and also in terms of understanding and de-risking the deal and really finding these really bright operators, strong operators that often can be hard to find in this space, right? So in terms of institutions lending to those folks, right, we're bringing more in capital into that space, and that should bring the cost of funding down, and that should provide more liquidity to what we believe is a very underserved market. Now, in terms of equity, right, they've been very invested in multifamily because of its steady returns, right? Because oftentimes what these institutional investors are managing, they're managing pension money, insurance money, endowment money, right? And going back to banks safeguarding your life savings or your college savings, right? They must do the same thing for their constituents. So they're finding the most core investments, the most protected investments that can pay out a fair return for having their money locked up, and so that they can balance out their liabilities that they have coming due.
Yeah. And how would you articulate the difference between, let's say, an operator that has 300 million in assets under management versus an institutional player? How are you looking at those operators differently?
There's a variety of differences there, right? In terms of the asset classes that they're going after, right? Or I should say the asset characteristics that they're going after. Typically, smaller unit counts, right? Sub 100 unit counts. Typically, as the $300 million group, they have an asset manager, someone heading acquisitions, someone on legal, if not third party. They either have in-house property management or they contract third party. But it's really sometimes a skeleton crew, sometimes more built out for the ones that have that institutional background and that want to grow from 300 million to 8 billion or 3 billion. And they have to set up that base, like I mentioned, so that they can grow quickly and within let's call it grow quickly and safely, right? For the institutions, right, they have large teams of risk managers, asset managers, acquisition teams, right? A lot of access to data and deal flow. That's not to say, again, that the $300 million AUM firm can't get access to the same data or deal flow at a local level, right? But oftentimes there is that disconnect. But really, as an institution coming in and lending to one versus the other, that's really the circumstances there that they're evaluating. And they also want to see that, the institution has had experience going through cycles and understands how to navigate these headwinds, especially the ones that we've encountered over the past, few years now. So it goes to speak towards, I would say, their ability, let's call it their acumen, investment acumen, operational excellence, right, to deal with uncertainty, because you don't know what you don't know, but that's all a part of kind of picking a horse, so to speak, making sure that they can run through any storm that comes their way. And I think whether those, let's call it heuristic assumptions, make sense or not, that's how they're evaluated. We use those same evaluation, let's call it metrics or standards, but we're also relying on a lot of data, macro data, market data, to show that, again, these sponsors are investing in a supportive environment where there are positive tailwinds such as net population migration, strong AMI growth, right? A good balance in housing supply, right? Housing stock that's being built. There's a variety of factors there that go into the more quantitative qualifications of the market and also the property. So, it's not just the sponsor, it's very much looking at all three holistically and then making a credit decision there.
Yeah, no, good insights right there. I mean, we definitely are looking for asymmetric type opportunities, right? Where we can have the least amount of risk, but the highest amount of upside. And, while there are higher standards, obviously, on the institutional side, that does come with a price, right? There's a lot of overhead in that institutional capital, which really dilutes investors' capital. So, whether you're trying to go risk off and that makes sense for you, you are paying a premium for that. And we've certainly seen institutions as well have challenges. They're not immune to challenges just because they have those additional resources. So, I think what we've seen is, trying to find that sweet spot, right, of operators that are unicorns really have some kind of strategic differentiator in a particular market that, their model is so buttoned up, right? And it's just kind of rinse and repeat. They know it really well. So, it's almost like angel investing, right? In a way, you understand what they're doing and they're doing a great job. So interesting thoughts. Maxwell, if you could give just one piece of advice to our audience about how they could accelerate their own wealth trajectory, what would it be?
That's a tough question. I mean, I think focus is key. I think focus is paramount, and it's hard to focus on multiple things. I think that finding something that you love, that you're good at, that is something that can be profitable, right? That's key, right? Because again, going back to just expecting the unknown, expecting headwinds, expecting problems, right? No one wants to deal with problems or have bad things happen, but it's, going back to how do you evaluate these sponsors in uncertain times? You got to make sure that you're kind of budgeting for that or thinking about it, taking some precautions there. But you can really only scenario out all of this and take a look at the broad spectrum if you're fully focused on one thing. And yes, that's a concentrated bet. But at the same time, if you're talking about building versus preserving wealth, right, those are two very different approaches. And I think that if you want to build wealth, you must concentrate. And to preserve wealth, you diversify. So, you mentioned, someone 38 versus 65, very different, right? And, you want to, at a hopefully earlier age, and I don't think there's a limit to that, but you do want to start as soon as possible, focusing on building something of value that you do love and do it consistently, because I truly do think with focus, success is a function of time. And you got to be able to give yourself that time. And being able to get that runway, you get that runway because you plan, because you anticipate. And that all takes focus. So that's, I don't have a particular trade or
I love it. That's great.
Investment, but that's really what I would say is the shape of successful wealth building.
Yeah, no, I think that's some good pearls of wisdom right there for people to think about that. Time is your greatest asset, right? And if you've got time and you can focus, if you don't have capital, you're not doing value creation, you can be focusing your efforts, learning, your education, your network, your relationship capital, right? These other components. So, that's helpful. If people would like to reach out and connect with you or learn more about what you're doing at Fulcrum, or obviously look for, lending opportunities, what's the best place?
You can reach us at fulcrumlendingcorp.com. We have a suite of tools there that folks can use to help find markets, evaluate properties. We can provide quotes within 30 seconds there. It's very much a self-serve model, but we also have a very white glove service where our originators will guide you along the way, every step of the way. But it's good to provide folks two options, right? Some people like to do it themselves, and we don't want to stand in the way of progress or someone else getting a deal done. Because like you said, debt is a lion's share of the cap stack. Knowing how much money you can get and how much it costs is very important if you're going to go put a bid in or evaluate, what in your portfolio you want to refinance. So, these are in the most simple sense, right? Time is very valuable there. And being able to get someone a speedy indication is key. But beyond that, you can reach us directly through the website, and we can connect you directly with the originator to speak more about what we do and what we can provide.
Awesome. Thanks for your time today, Maxwell. Really appreciate it.
Thanks, Dave. Thanks for having me on.
Yeah. Hey, guys. And if you've been enjoying the show and you found value in the show, please go ahead and follow the show, and please give us a rating and review so we can continue to get great guests like Maxwell on the show and continue to spread the education. Appreciate it. Until next week.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.